With visibility for strong cash flow upside, these companies are likely to reward investors through robust dividends and share repurchase. These are the best dividend growth stocks to buy at attractive valuations for high total returns. Lockheed Martin, an order backlog of $156 billion and a healthy order intake will ensure revenue growth and free cash flow upside. Merck. It boasts a strong pipeline of potential drug candidates that provides visibility for growth. Kinross Gold. It's positioned to benefit from higher realized gold price. Let's dive in. Here are the 3 best dividend growth stocks to buy in January 2024. Welcome to Timely Investment Research. Within the dividend stock portfolio, there is a case for finer diversification. First, there are blue-chip dividend stocks with stable cash flows and relatively muted dividend growth. Further, there are some of the best dividend growth stocks to buy that also trade at attractive valuations. This video focuses on the dividend growth stocks that are worth considering at current levels. The first screening for some of the best dividend growth stocks is historical dividend growth, compound annual growth rate. Further, these are companies where margin expansion and cash flow upside are likely to be robust. This will translate into healthy dividend growth coupled with potentially higher share repurchase. I also believe that these dividend growth stocks trade at attractive valuations. In the next 24 months, total returns from a portfolio of these stocks can comfortably beat index returns. Let's discuss the reasons to expect healthy dividend upside. Number 1. Lockheed Martin. Lockheed Martin stock looks attractively valued at a forward price-to-earnings ratio of 17. Further, Lockheed Martin stock offers a dividend yield of 2.72%, and I expect healthy dividend growth from this defense play. To put things into perspective, Lockheed has increased dividends at a compound annual growth rate of 9.78% in the last 10 years. Given the fact that the backlog is swelling on the back of higher geopolitical tensions, I expect a similar compound annual growth rate in the coming years. As of third quarter 2023, Lockheed reported an order backlog of $156 billion. Domestic and international order intake has been robust, and this sets the stage for sustained upside in free cash flows. For last year, Lockheed had guided for free cash flow of $6.2 billion. It's likely that free cash flow will be similar or higher in 2024. It's worth noting that Lockheed is also on the forefront of innovation. This includes hypersonic solutions, directed energy, and next-generation space capabilities, among others. The innovation edge is likely to ensure that backlog growth remains stellar. Number 2. Merck. Merck stock is another attractive name among the best dividend stocks to buy. In the last 10 years, dividend growth has been at a compound annual growth rate of 6%. However, over a period of 5 years, dividend growth has been at a compound annual growth rate of 9.3%. I expect a similar trend in the coming years. One reason to be bullish on Merck is a strong product pipeline. Currently, the company has 80 programs in Phase 2 and another 30 in the third phase. It's worth noting that since 2019, the company has invested $50 billion towards strategic business development. Recently, Merck acquired Harpoon Therapeutics for a consideration of $680 million. This will help in broadening the oncology pipeline. Overall, these investments will translate into sustained growth and cash flow upside. I must add here that Merck is targeting operating margin expansion to 43% by 2025. This will translate into robust free cash flows and hence visibility for dividend growth. Number 3. Kinross Gold. There is a strong case for gold going ballistic this year. The reasons include the possibility of multiple rate cuts and heightened geopolitical tensions. My view is underscored by the fact that central banks have been aggressively buying gold. A good proxy for gold investment is exposure to gold mining stocks, and Kinross Gold looks attractive. It's worth noting that Kinross Gold stock is undervalued at a forward PE ratio of 14.3. Further, the stock offers a dividend yield of 2%, and I am bullish on healthy dividend growth as realized gold price increases. As of third quarter 2023, Kinross reported a liquidity buffer of $2 billion. Further, based on third quarter free cash flows, the company has an annualized free cash flow visibility of $500 million. It's likely to be higher this year, and strong fundamentals set the stage for dividend growth coupled with share buybacks. I also believe that Kinross will be pursuing opportunistic acquisitions considering the financial headroom. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.